We are now in our mid-morning report, and one of the key themes that we've been hearing over and over again, not just in this conference, but some of the conferences that we've had with Sibos in the past couple of years, have been regulation. And we're going to find out now about the future of regulation and where specifically we are on the journey towards that. And here are my esteemed panel of guests with their game faces on. Let's start. Closest to me, Jim Fries is with us. He's a counsel at Cleary, Gottlieb, Steen and Hamilton. Also with us is Karim Rajwani. He's the global head of AML at Royal Bank of Canada. Hans-Peter Bauer is a member of the board of the Basel Institute on Governance. And Martin Pearson is a director of group services at the Royal Bank of Scotland. Guys, thanks very much for coming in. So we've got a lawyer, we've got a banker, we've got a regulator, and we've got another banker. So that's putting it all in perspective. Let's start with you, Jim, first. Actually, no, let's start with you, Hans-Peter, first of all, because I understand your session on regulation and the journey continues. That's going to happen at 2 o'clock in conference room 1. Tell us, give us a sneak preview of what you've got in store.
Now, we will focus on how regulation has developed over the past 10 years and where we see it going. Mm-hmm. I think the important change is that historically correspondent banking, and that includes payment, documentary credits or custody business, have been considered a fairly risk-free business. Mm-hmm. But the regulatory environment has changed this completely, and now it's considered a very high-risk business. It's not because credit risk or market risk or operations risk have gone up, but because the business has become so regulated that violating the regulations is now really the risk. So banks have to fill a lot of tasks. They have to do KYC, they have to analyze the counterparties they are dealing with, which they didn't do in the past. They have to assess the risk, which is in particular risk related to money laundering or terrorism finance. Mm-hmm. So they have to look into the countries where those banks come from. Mm-hmm. And then finally, they have to screen and monitor all the transactions that they are doing with these banks. Mm-hmm. So that is very different from what we had seen 20 years ago. Mm-hmm. Now that puts a lot of strain on the banks, and what I see coming is that this risk makes the business much more expensive, because dealing with a counterparty now involves a lot of work that is very costly. Mm-hmm. And therefore banks will have to think twice about whether a relationship is still economic to continue, mm-hmm. Or whether it's become too risky. And I see two developments in there that are of particular significance because of this review. Banks will think about exiting their relationship with a number of countries. Mm-hmm. We have seen two major banks, one from the US, one from the United Kingdom, who have just exited their relationship with an African country because they think the risk has become too high, mm-hmm. and they can no longer control this to their own satisfaction. Mm-hmm. And therefore you're always afraid to be found out and to be accused of wrongdoings. Mm-hmm. And the second is that smaller banks in high-risk jurisdictions, or which are intransparent or which are not profitable, will be filtered out of the system, mm-hmm. which will lead to a concentration of this whole business. Mm-hmm. So regulation will not only put pressure on the banks, it will also have an impact on the whole business model, mm-hmm. and in the end, on the whole industry.
Mm-hmm. And it's guys like Jim that are becoming very, very wealthy men, because the banks have to pay a lot of money to actually analyze and assess this regulation and find out what is exactly that we've got to do. Jim, how are you helping banks to do this?
Well, as an ex-regulator and newly on the side of working with the banks to try and interpret what these regulations mean and what they're intended to do, it is really interesting. The first observation I'll make is that it's the issues that so many people deal with here at Sibos, payment systems, behind the scenes. Similarly, that's the history of compliance, mm-hmm. and some of regulatory issues. It's amazing to see the focus here at Sibos that it's really a frontline mm-hmm. issue on everyone's mind. And it's natural in a way. Regulation historically has always been a creature of crisis. Mm-hmm. It's never been the case that the regulations that came after a crisis actually got to all the issues of that were the causes of the crisis. It's easy to say in hindsight. So now we're moving to phases of the challenges of implementation.
What do you think, from the banks that you represent, what do you think are the things that they have the most issues with, that are the biggest stumbling blocks for them?
The biggest stumbling blocks are when we are facing the notion of principles that are the same across jurisdictions. In a way, there's been unprecedented cooperation, whether that's through the Basel Committee on Rules with respect to capital, the FATF with respect to the anti-money laundering, counter-terrorist financing, the Financial Stability Board, to even at the political level, presidents and prime ministers endorsing principles of consistent banking regulation. But we're still focused with the aspect of differing implementation in every jurisdiction. Traditionally, institutions would look at it on a country-by-country jurisdiction approach. But now the biggest single change is the expectation that institutions will have a group-wide approach to compliance. It's changing the way they've had silos within business lines, profit centers, and interestingly, we see some of the biggest global banks that are actually making decisions for the first time to exit business lines that have in some cases been profitable because they are taking into consideration the compliance risk and whether that fits with a global strategy.
So,
yeah, certainly we see the regulatory bar expectations continue to rise. I'm faced with operationalizing the expectations. A particular area of challenge for us is monitoring a customer on a global basis. We don't have common systems, common identifiers, and these are some of the challenges we're dealing with. Now, fortunately, I think we're at a stage where technologies and methodologies are developing. We are able to dive deep into our transactional activity, which we can leverage. The challenge is, particularly in correspondent banking, you're not only monitoring your client, you're monitoring your client's clients. AML programs are not the same across banks, and so that's one of the challenges we face is the downstream banks or the upstream banks where we're little information, and this is where I think institutions are saying, we know so little about this segment, we know so little about this country, perhaps it's not the best investment of our time and money at this point. And that may, in the long term, may have negative consequences for, for our industry. But those are the tough decisions I think we have to make.
It's that depth that's now required. And so we've known about AML and sanctions, for the last 5 or 6 years. And we've developed SWIFT and Sibos to spend more time talking about compliance and those concepts. But that's just one of the pressures that a large global bank or a small, medium bank is actually facing in terms of regulation. We talked about compliance being much, much bigger than that. Risk is getting much bigger than that. So we're now talking about this concept of resilience more generally for organizations. So not only do they have to be very, very good at dealing with AML and compliance, they've got to be incredibly good at making their organization much more resilient. They've got to be good at responding to all of the upstream regulatory changes. So FATCA is no longer a US thing. It is a global issue. So while we're getting much better at dealing with AML sanctions, there's many, many other things that we have to be focusing our efforts on. And some of that comes back to one of the big concepts we've talked about through the Compliance Forum, which is the culture and the tone from the organization. People are now getting how serious this actually is for them and their businesses.
Certainly, where we see the anti-money laundering industry moving is in the same place the fraud industry's moved. Consortiums, common solutions, going to common vendors, because not only does that reduce the cost of compliance, but overall makes the program more effective because you're operating as a collective and monitoring as a collective, and that's just the natural progression of our industry.
This is really critical that institutions, before they look outside to the consultant and try to figure out a new regulatory requirement in a vacuum, they figure out what they know first. Exactly, the fraud and anti-money laundering is things that people have been developing much more closely than naturally in the past. Every institution has an incentive to combat fraud, losses either to the institution or to its customers, because customers with no money are not very good customers. You know your customer when you're going to give them a loan because you want to be repaid. And some of the insights from that can also be taken on the side when the customer takes the credit risk on you. Similarly, with respect to new regimes such as the FATCA, one of the premises is know your customer, anti-money laundering. How can we learn from that? How can we leverage systems in that regard? And there's a lot more, even in areas such as the Volcker rule or Vickers or Leikanen, to divide up. There's an expectation that there will be a compliance program of the same components that we know for years in anti-money laundering, the compliance officer, the policies and procedures, the training, the internal audit. So we can learn and we can leverage some things in that regard.
I think the good thing, certainly from what I've heard in this panel, is I've heard the customer mentioned 2 or 3 times. And again, in regulation moving forward, we will have to give much more focus to the services we provide to our customer. That is a big piece of new legislation in the UK in terms of treating customers fairly. It will become a much more important concept to how we set up our systems, the procedures, the process, and again, the culture of the organisation. Customer has to be king.
I want to get back to you, Hans-Peter, because reading some of the press here within the Sibos conference, all those magazines that are just across the way there, I came across a few themes this morning talking about, as a regulator, do you feel that we've got a community of bankers that are just whinging, this is the new normal, come on, let's get on with it, and what kind of more cooperation in terms of the future are you looking to get from them?
I think one of the basic features we have created is expectations. Banks are expected, when you talk about terrorism finance screening, to perform 100% identification of Dutch payments. Or on money laundering, we shouldn't forget money laundering is a criminal offense. So we are not talking about regulation in the traditional sense. We are now talking about the violation of criminal law. And you combine this with the high expectations on full efficiency. That makes this so dynamic and makes this so dangerous. And I think going forward, the industry and the regulators should sit together and probably in a way become a bit more realistic. Certainly the banks can do more over time, but on the other hand, we have to be careful not to overplay our hands and expect too much and expect a performance that in the end is not achievable. If you go through customs, everybody knows that there is a certain percentage of illegal immigration, but if a bank would argue that they know that their systems are violated to a certain extent for terrorism finance, or for money laundering, they would be out of business tomorrow. So the expectation to have 100% compliance that we have created has become a risk by itself.
Come back on that for me as a banker.
Yeah, and that is the challenge. I think we need to see this business as a continuum from the point the customer walks in to the point of prosecution. And it's not just the banks or just the regulators. It is a community. We've all got to do our piece in this game, or we will not achieve the end goal.
Okay, well, we've got to leave it there. Best of luck at your session. Everybody, that session on regulation and the future of regulation.